If you've been following the markets at all, you've definitely heard the name Hims and Hers. I mean, this telehealth company has become a total Wall Street darling, with a stock price that's just gone to the moon. But whenever you see a rise that steep, you gotta ask the question, is this a truly revolutionary company building an unstoppable business? Or is it a hype-fueled rocket ship that's about to run out of fuel and come crashing back to Earth? So what's the real story here? Let's break it all down.
All right, here's how we're going to tackle this. First, we'll look at the bull case, why everyone's so excited about their explosive growth. Then, we're going to hit the brakes and get an analyst's reality check. We'll dive deep into this critical, no-moat debate, and then unpack how weight loss drugs are both their biggest growth driver and their biggest risk. And finally, we'll look at a potential game changer that could literally rewrite the entire story.
Okay, first things first. Let's dig into why investors are so hyped up. And honestly, when you look at the numbers behind their growth, they're pretty staggering. Now, what's really wild about this chart isn't just that it goes up, it's the speed of it. I mean, after a few years of just kind of steady progress, whoosh, the stock just launches, turning this company into a nearly $12 billion giant. This is the kind of chart that makes everyone sit up and pay attention. But hey, this isn't just market hype or smoke and mirrors. That valuation is being built on a real and rapidly growing user base. As of the third quarter of 2025, Hims and Hers is serving close to 2.5 million subscribers. That is a massive digital patient list. And you know what more users means, right? More money. A lot more. Their revenue jumped an incredible 49% in just 1 year. We're talking from around 400 million to nearly 600 million in just 12 months. That's pretty much the dictionary definition of explosive growth. And you can see here, this isn't some one-time fluke. It is a clear, consistent trend. They've gone from under 300,000 subscribers in 2020 to over 2 million by 2024. But here's the really interesting part. Look at the strategic shift. The percentage of their users on personalized plans has more than quadrupled since 2022. That shows they're moving towards customized medicine, which is absolutely crucial for keeping customers around long-term. So the growth story is, yeah, it's powerful. It sounds amazing, right? Well, hold on. Not everyone is convinced. Now we're going to pivot to the other side of the argument, where some expert analysts are waving a big yellow caution flag. And this slide just says it all. This is the core of the whole debate. While the market was happily pricing the stock at over $52, top analysts at Morningstar were looking at the fundamentals and saying, whoa, hold on, we think its actual value is closer to $25. That is a massive disconnect. So what on earth does fair value even mean? It's not just a random guess. Think of it like this. It's an analyst's best attempt to figure out what a company is actually worth, based on the cold, hard cash it's expected to make in the future. It's about separating the business reality from the market's day-to-day mood swings. And the reason for that huge valuation gap? Well, it boils down to a fundamental disagreement about what the future holds. Hims and Hers' own management is aiming for a super ambitious $6.5 billion in revenue by 2030. Morningstar's forecast, though, is way more conservative at $4 billion. Why? Because they see new competitors jumping in and big problems in a key product category.
And that brings us to one of the most important ideas in business strategy, and a major point of contention for Hims and Hers: its ability to actually defend its turf.
You hear this term economic moat thrown around a lot. It's basically a company's sustainable competitive advantage. It's exactly what it sounds like. Think of a castle's moat. It's the thing that protects a business from being overrun by competitors, which lets it protect its profits for the long haul. And here you can see the analyst civil war in plain sight. Morningstar is crystal clear. Hims and Hers has no moat. They argue competitors can just copy what they do pretty easily. But then you have other analysts, like the ones at Fiscal.ai, who see it completely differently. They think a moat is forming from the company's huge size and the network effect of its platform. You've got two experts looking at the same company and coming to totally opposite conclusions. So let's just boil this down. On one side, the bulls see a really smart company riding this massive wave of digital healthcare, and it's cross-selling new products to a loyal customer base. The bears, on the other hand, they see a business that's easy to copy, faces serious legal risks, and might be spending way too much on marketing to keep the whole thing going. Okay, now we have to talk about the elephant in the room. The one category that has fueled so much of this recent hype, but also represents the single biggest risk to the company: weight loss treatments. You remember when it was impossible to get blockbuster drugs like Ozempic and Wegovy because of those shortages? Well, Hims and Hers made a really clever move. They stepped right into that gap, offering compounded versions through their platform.
It was a masterstroke that tapped into enormous demand and drove a huge chunk of their recent growth.
But here's the catch. That shortage, it's over now. And with the official branded drugs back on the market, analysts like Morningstar are predicting that this massive river of revenue is about to shrink, and shrink fast.
What's even more concerning, though, is the legal minefield. Hims is still offering these compounded drugs, but the big pharma giants are fighting back hard. Novo Nordisk, the company that makes Ozempic, has already filed over a dozen lawsuits against other companies doing the same thing. Now, Hims hasn't been named yet, but analysts see this as a major legal storm cloud just hanging right over the company.
So you've got this epic tug-of-war happening, incredible growth on one side and some pretty significant risks on the other. What in the world could possibly break the stalemate and decide the future for Hims and hers?
Well, unsurprisingly, the company's leadership is projecting extreme confidence. On their latest earnings call, the CEO, Andrew Dudum, pointed to new partnerships with healthcare leaders as the key to everything. He's basically framing Hims and hers as the leader of a whole new era of healthcare.
But, of course, that's what a CEO is supposed to say, right? The real question is, what kind of partnership could possibly be big enough to settle the whole moat debate, justify that sky-high stock price, and solve the massive legal dilemma with weight loss drugs all at the same time?
And then, this happened. Literally, as we were putting this analysis together, a bombshell dropped. In a really stunning move, Hims and Hers announced it was in active talks with none other than Novo Nordisk, the very company that posed its single biggest legal threat.
So what are they talking about? The plan is to sell official, branded Wegovy injections directly on the Hims and Hers platform. This would be an absolutely monumental pivot. In one move, it would vaporize the legal risk from compounding and turn a potential enemy into a massive, industry-leading partner.
So, we end with this final thought. Now, a deal isn't done yet, but the fact that these talks are even happening is a potential game changer. I mean, if a digital-first company like Hims can actually partner up with a pharmaceutical titan like Novo Nordisk, it might not just settle the debate for one company, it could fundamentally reshape the entire future of digital healthcare as we know it.